love the channel and find it useful in becoming a happy retiree. Subscribe today.
Back to Wes Moss with the money and investing advice you need.
Since 2009, despite markets, S&P 500 tripling from their lows, there have been net outflows from stocks, making this the least loved bear market probably of all time. Mutual funds have gotten the brunt of that. So if you look at, when we can track this, you can go all the way back to 2009, all the way to 2018 year to date, you can track how much money is net positively flowing into stock, mutual funds, and then of course stock ETFs, international mutual funds, international ETFs, bonds, etc. So we can kind of track and see the temperature or the barometer of where people want to put their money. Again, since 2009, we have seen a net outflow from U.S. equities to some extent. So mutual funds have gotten the brunt of that. Minus $1.1 trillion have come out of stock mutual funds in the United States over the last almost decade. International, we've actually seen an inflow for international to the tune of about $1.1 trillion. And that's both mutual funds and ETFs. If you go back to the domestic equity example that I'm giving you here, we've seen net outflows from U.S. mutual funds of $1.1 trillion. Equity ETFs have taken in $873 billion. So it's not as bad as I just made it sound. But you have a net outflow still that's almost $300 billion. Almost $300 billion out of U.S. stocks. Yet bonds, and here we face with still these very, very historically low interest rates, even though they've gone higher, bonds have taken on nearly plus $2 trillion, $1.9 trillion of net inflow from 2009 until today. That tells us something. We're in a bull market, and we know that, even though the last several months are basically trading sideways, treading water. The S&P 500 or the Dow for the year is actually just slightly net negative. S&P 500 is up 1.4% with a lot of angst to boot. So a lot of movement to effectively go nowhere. All these cross currents that we're talking about that have kind of put a lid on markets, at least for now. We know, though, that over time, participation in markets is the key, not perfection.
Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.